The Dow Jones Industrial Average is a collection or index of the top 30 blue chip companies that trade on the New York Stock Exchange and the Nasdaq. It is widely regarded as a benchmark for how the US economy is looking and is one of the world's most renowned stock market indices. And that is why I trade it every day. Created way back in 1882 by Charles Dow and Edward Jones, with the revolutionary idea to give an overview of the general market conditions and economy, the Dow Jones is one of the oldest indices on the US market. But back in those days, it only comprised of a shipping company, a communications company, and 9 railroad companies, a real testament to the sheer supremacy of the railroad in late 19th and early 20th century America. And so because of this, the Dow Jones was known as the transportation average. But then, about 15 years later, in 1896, they split it in two, creating the now better known industrial average. Back in those days, the performance of industrial companies was generally associated with how well the economy was doing, which to this day has led to the Dow being the go-to benchmark for the overall economy in the US. Now, there were 12 companies back then that made up the industrial average, comprising mostly of companies dealing in oil, gas, cotton, sugar, and tobacco. And the average was taken by adding up the prices of all 12 stocks and then dividing that number by 12, creating a very simple average. Nowadays, the average is made up of 30 companies, all chosen by the editors of the Wall Street Journal, including Apple, Microsoft, Disney, Nike, Coca-Cola, McDonald's, Boeing, and Walmart, just to name a few. But the average is worked out in a very different way today in order to compensate for things like stock splits and dividend payments. And this is where it all starts to get a little bit complicated. Now, instead of adding up the stock price of the 30 companies and dividing by 30, they divide it by the Dow divisor. Sounds like some sort of wrestler.
The Dow divisor.
This is a number that is continuously adjusted to maintain continuity and to ensure that any structural changes to the market do not influence the Dow's validity as a benchmark index. The value of the Dow divisor has changed massively over the years. For example, in 1928 it was at 16, and in 2019 it went all the way down to 0.1. At the moment, it is around 0.1517275259538.4, but we don't care about any of that. Now, the index is weighted, which means that the Dow moves in accordance to the share prices of the 30 companies, and those who have the highest share price will make more of an impact to the calculation of the Dow. So at the moment, the company with the highest share price of $460 is United Health Group, and the company with the lowest share price of $53 is Verizon. So the price of the Dow will be more affected by the performance of United Health than it will of Verizon. Make sense? Alright, so come earnings season, you want to be looking at the companies on the Dow with the highest stock price and looking at their earnings reports. You can do this by Googling Dow earnings calendar to see which companies are releasing their reports today. And here we see that Procter & Gamble and United Health Group will be announcing their earning report before the open of the market. So if we go back to our list of Dow components, we can see that Procter & Gamble are 17th on the list in order of highest share price, but United Health are first. So clearly United Health's performance will be more influential to the value of the Dow. So an hour before market open, I'd Google United Health stock and look at the news to see if their report was good or bad. And in another example, a few days ago, Goldman Sachs, the biggest bank and third most valuable component of the Dow, released their earnings report for the last quarter of 2021. And it missed expectations by a long shot and consequently dropped by more than 7%, causing a similar reaction on the Dow, itself tanking by over 500 points. Now, on this particular day, there were some other reasons for the Dow being dragged down, and that was because of rising inflation concerns. And this was evident in the 10-year Treasury yield as it hit a 2-year high. Now, when this goes up, it's a sign of an increase in future interest rate hikes, and they don't bode well for growth stocks, mostly in the technology sector. So consequently, you'll see the Nasdaq take a big hit as well as the Dow. So because of the poor report from Goldman Sachs, as well as the current inflation crisis, I took a short position right at the market open. I rode it all the way down to a point where I had vastly overstepped the point of excessive greed and closed out banking £700 in 5 minutes. So I'll do a more in-depth video on inflation and the 10-year Treasury yield very soon, as these are huge factors that dictate the way the stock market moves, and it's especially a very hot topic at the moment, so every trader should have an understanding and keep a close eye eye on it, and if you haven't done so already, check out my video on how to read and analyze earning reports by clicking this. Now, earnings season comes but 4 times a year in January, April, July and October, and each lasts about 6 weeks or so. The other strategy to trade the Dow every day is to forget about earning reports and just exploit the price volatility at the market open. At 9:30 a.m. in New York, the market opens, that's 2:30 p.m. in the UK, and at that time there is a huge influx of volume in the markets, especially on the Dow. And without looking at earnings reports, we just trade the price action at the market open, as there are often some big price moves around this time. And we can aim to bank 20 to 100 points. Now, all of this is tricky and takes a lot of practice to know when to time your entry and your exit. So if you're inexperienced in this, then open a demo account and try it out and keep practicing it. I'm also going to be doing a video very soon on identifying price action and how to use it to make money. So make sure you're subscribed and that you get notified so you don't miss any of these videos. Now, this is a trade I made on the Dow at market open, and I'm just trading the price action here, not trading earning reports. So the market has been open for 5 minutes here, and you can see it has spiked up by about 60 points and has started to slow down a bit. So I'm going to get ready to spot an opportunity to place a short position. Now, I was a bit hesitant to jump straight in at this point, so I let it do its thing and pray that I hadn't missed my chance. But it looks like I was a bit too slow to grab this one, as it has come down to halfway of that big spike. So now I have to wait for another opportunity. Now, I could go long here, as after this little drop down it's quite likely to recover back up to the previous level, but at this midpoint it's a bit risky as it could go either way, so I'll wait a little bit longer. And now it's on the rise again. So what I'll do this time is see if it wants to hit that top resistance level again, and this is a significant resistance level as it is around the round number of 3600, so it's going to find a lot of resistance here, as many people would be liquidating their positions at this point. You can see over here on my pivot point chart that it tested this level earlier on and it found resistance then, so this to me is looking like a great opportunity for a short position. I'm just going to wait for a little pull up so I can get into the best position. In this case, I want my short position to be as high up as possible. And that's where I'll enter. And that looks pretty good to me. Now here it starts to fall, which is what I predicted. And I've put in a take profit order of 20 points, which is $100, just to stop me from being greedy. And we'll wait and see if we can get there. If the price goes against me and breaks through the resistance level, then that is where I'll close the trade and take the loss. Because if it breaks through there, then it's going to shoot off to new heights. But it's looking good at the moment, and it's almost there. And there we go, $100 in the bank from just observing a little bit of price action. The price spiked up considerably, so I looked for an opportunity to take a short position. The price found significant resistance at the key level of 3600, which is where it had failed to break through twice before. And I'd waited for the price to get back up as close to that resistance level as possible before I placed my short entry. I also protected myself from greed by putting in a take profit order, and I walked away with $100 in less than 15 minutes. And that is how I trade the Dow Jones Industrial Average every single day. And this kind of trading works for other indices as well, such as the Nasdaq and the FTSE 100. Now, if you can't find the Dow Jones on your broker, it might be called something different. On mine, it's called Wall Street. The Nasdaq is called US Tech 100, and the FTSE 100 is called UK 100. So I hope you enjoyed that little history lesson on the Dow. It's all fascinating stuff and amazing to think that it's still going stronger than ever after 140 years. Now, if you do decide to start trading indices, then make sure you practice with a demo account in order to get used to how these indices move, because they move fast and your timing will greatly impact how successful you are, which takes a lot of practice. So take your time and don't rush in. But in the meantime, you know what to do with the likey and subscribey, and I'll see you next time right here on Math Market.